So the bond street always looks out for one key number among other things, which is where is the fiscal deficit likely to be tabled at, because that would set the tone for the incremental borrowing program for the next financial year. So I think like no exception, this time also the bond markets will be keenly watching out for the fiscal deficit number. If there is a minor slippage, say 10 to 20 basis points on the number that they've agreed upon, we're not really expecting any major carnage on the market front. Sentiment might be probably temporarily impacted, but otherwise the fiscal deficit would be the key number to watch out for, at least from the bond market perspective. See, RBI has been talking about two key things. One is the inflation should remain benign, which is the Consumer Price Index or CPI, and there should be a Fiscal Consolidation Act. So we are visibly seeing a lower CPI. So if you see the recent numbers, also the CPI came in at 5.1% and the core CPI came in at sub 4%. So that is clearly one ingredient which pushes the case for one more rate easing between, say, the budget period, which is 28th of Feb and April 7th, which is the next monetary review. And the second thing is, of course, as I said, the fiscal consolidation. So if this budget really walks the talk and sticks to the path of fiscal consolidation, then it is our belief that there could be one more meeting rate cut, which would take the overnight repo rate to 7.5%. In case there is a relaxation on the fiscal front and we really don't see that materializing this year, then our belief is that the rate cut cycle may slightly get more prolonged than what we all anticipated. Currently at overnight rates at 7.75, the 10-year GSEC yield is pretty much around the similar levels. We expect the repo rate to be in the band of 7 to 7.25% by March 2016. So in that breath, we also expect the 10-year to show a similar kind of easing. So I think the yields in the bond market could be at least 50 to 75 basis lower from the current levels by March 2016. So inflation obviously has a positive impact. So the lower the inflation, lower the interest rates. At the current juncture, we are seeing visibly lower inflation, and we are well on track to achieve the RBI's target of 6% by Jan 2016. So intuitively, as I said, assuming the fiscal also continues to act in this favor, we are likely to see lower interest rates aided by a lower inflation. So clearly they have a direct correlation. So liquidity currently also in the system is fairly acceptable level. We have about 70 to 80,000 crores of liquidity. It is our belief that going forward, maybe between now and March 15th, there are these couple of things because of which the liquidity could get a little bit tight. Which is obviously the advanced tax flows and also partially led to because of the spectrum and the coal auction outflows. However, we believe that RBI has demonstrated in the past that they will keep a reasonably orderly liquidity. To that extent, we're not really expecting any negative surprises, at least on the liquidity front. So in the fixed income market, I think the three key risks are obviously the interest rate risk, the credit risk and the liquidity risk. And at the current juncture, when we are looking for potential capital gains, it is the interest rate risk that plays a paramount importance. So investors need to be cognizant of the fact that if they are coming into the duration funds or the long category funds, it has an inherent embedded interest rate risk in it. And therefore, you have to be there for an extended investment horizon. I would say anywhere upwards of 18 to 24 months, below which obviously there could be volatility in these funds, and assuming that the trajectory of interest rates don't pan out as per envisaged, then the risk is that the investor needs to be mentally prepared that he or she needs to elongate one's investment horizon, and that is very, very pertinent in the current market scenario.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.